Good afternoon, everyone. I hope you guys all doing well. And on behalf of the South African Business Council and MBG Corporate Services, I'd like to formally welcome you to our webinar today, which is on the topic of corporate tax in the UAE. My name is Sajid Ghani, and I am the Secretary General of the South African Business Council. Now, as many of you already know, the UAE government announced earlier this year, I think in January 2022, that they will be introducing a federal corporate tax regime on business profits. And this is going to be effective for all financial years for companies starting on or after the 1st of June next year, so 1st of June 2023. Now, apparently, the UAE corporate tax regime has been designed to incorporate best practices globally, which I think we will all come to expect, and to minimize the compliance burden for UAE businesses. So, in essence, businesses in the UAE need to prepare for 9% corporate tax implementation, which, as I said, takes effect by the 1st of January 2023. Now, businesses will need significant lead time to prepare their employees, their customers, their vendors, and the IT systems, of course, for the introduction of the corporate tax. There'll be lots of initiatives to assess what are the corporate tax liabilities. Businesses would need to really understand what's needed. They would need to develop a plan to identify the necessary steps to be taken for the implementation. And further, the businesses will have to analyze its own transactions to determine all future corporate tax liabilities and related compliance obligations. I think it's imperative for early preparation, because early preparation will allow avoidance of increased implementation costs at premium rates at a later stage, as well as potential pressure on internal teams to complete readiness within a very, very tight time frame. But thankfully, today we have the experts with us, experts from the MBG Corporate Services Group, who is an international consulting and advisory firm. And they've got significant experience in the implementation of corporate tax in various jurisdictions around the world. And today they're going to give us a detailed overview of what does it mean once corporate tax is implemented in the UAE. So they're going to talk about some of the key concepts and the provisions, which in essence form the basis of the public consultation document that was released by the Ministry of Finance in the UAE. So we have two experts from MBG with us today, and I'm going to introduce you to them quickly and then allow them to get on with it. So firstly, Mr. Manoj Pandey, he leads MBG's tax practice in the UAE and the GCC, in fact, and he specializes in development of tax strategies, transfer pricing, cross-border taxation, M&A services, etc. In addition to being the senior partner for corporate tax with MBG, he's also the COO. He's advised several strategic corporate buyers, and PE investors through entire M&A deal life cycles, from conception of strategy through to selection of partners, due diligence, right through to closing the deal. Manoj is a chartered accountant by profession with more than 20 years of professional experience in the field of regulation and taxation. Just interestingly, I think for the benefit of everyone on this call specifically, he's going to be talking a lot on what is the impact on the tax treaty between the UAE and South Africa, which I think we're all very keen to hear more about. The second speaker from MBG today is Mr. Vinit Gala, who is the Senior Manager for Corporate Tax at MBG. Vinit has been actively involved in advising clients on international tax matters. Once again, tax treaties, etc. And tax matters arising out of cross-border transactions. He's been engaged in structuring cross-border transactions from an international tax perspective, and he's also advised clients on strategizing transfer pricing models to ensure overall tax optimization. He is also a qualified CA, and he's got more than 10 years of professional experience. So I'm going to be handing over to our two experts shortly. But before that, we want this to obviously be an interactive session and not just a one-way PowerPoint presentation. And I have no doubt that many of us have got lots of questions. So I'm going to ask you to please actively post your questions. Two ways of doing it, either on the chat box or by pressing the Q&A button. And we've got someone from MBG who will be curating these questions. And then at a later stage, once both speakers are done, we will then post your questions to them and hopefully get some satisfactory answers to those questions. So that's it. That's it for me. I've been talking too much already. I'm now going to hand over to the experts from MBG, to Mr. Vinit Gala and Mr. Manoj Pandey. Guys, over to you.
Once again, very good afternoon to each and everyone present over here. And thank you for making time in this afternoon and, understanding the interesting topic of corporate tax, which has been announced in UAE. So quickly, I will be navigating you through the key policy framework and the basic provisions of the corporate tax as we see from the public consultation draft. So to start with, in January 2022, we had a press release from the Ministry of Finance stating UAE would bring in corporate tax. And along with the press release, we had few frequently asked questions published on the Ministry of Finance website. And it was followed in April 2022 by the public consultation draft, which lays a blueprint of the proposed corporate tax law in UAE. So as far as the vision of the corporate tax in UAE is concerned, the ministry has laid a context in the public consultation draft, stating they are going to be aligning it with the global best practices with the application of the internationally known and accepted principles. So we do not expect anything new to come in the corporate tax, which is not known internationally. And simultaneously, they would keep the provisions simple with a reasonable clarity to facilitate transparency. And it would be based on a neutrality and the principles of equity, with ensuring minimum compliances and encouraging competition, growth, and foreign investments into UAE. And simultaneoslly also, keeping the law agile and pragmatic with the emerging new models, especially keeping in mind the digitalization space which we have in today's world. So as far as the key policy framework is concerned, we will have a progressive rate of taxation in UAE, 0% and 9%, and potentially 15% for the entities which are part of the larger multinational groups, which have a consolidated annual turnover of 750 million euros or more. Secondly, we'll have a transfer pricing regime as well in place under the corporate tax law. And as far as benefits are concerned, we'll have some benefits for free zone entities, potentially having a 0% corporate tax rate. However, compliances would stay in for the free zone entities, though they would enjoy a 0% corporate tax rate. Along with the benefits for the free zone, we also have exemptions for certain streams of income, that is the dividends, capital gains, and foreign branch profits. And from a restructuring standpoint, we would have certain exemptions for an eligible intra-group transactions and reorganization in place. Some of the welcome step as of now to be a business-friendly law. De facto, we would not be having any withholding tax in the UAE corporate tax law, though the draft mentions certain streams of income to be subjected to 0% withholding taxes. However, we do not have a compliances in place for that withholding of 0%. So de facto, there would not be any withholding tax as of now. And simultaneously, they have certain concepts of tax group and intra-group transfer of business losses. This is also a very welcome step. As far as losses are concerned, in case entity is newly set up, having a long gestation period, etc., we would be having a provision of carry forward of the losses for infinite period. However, certain conditions would be prescribed as far as carry forward of losses is there. Then we would not have any payment of any advance taxes. So the taxes will have to be paid when the year ends before the annual return is filed for the corporate income tax. As far as computation of tax is concerned, again, the way the draft is worded, it would be simple, and the basis would be the accounting net profit. Of course, the accounting net profit would have certain adjustments to be made so that we arrive at the taxable profits. And as far as individuals are concerned, a good news again for a national persons like you and me, we will not be subject to corporate tax unless we are having any business or commercial activity in UAE. So in a nutshell, we have the key policy framework. Some aspects I would be dealing in detail in the ensuing slides, and few concepts would be dealt by Mr. Manoj Pandey. Starting with the concept of a taxable persons under the UAE corporate tax, we start with the natural persons like you, individuals like you and me. Again, the way I said, a good news and a welcome step for us. We would not be subject to corporate tax unless we do a business or a commercial activity, which needs a business or a commercial license in place. The form of activity which an individual would be subject to tax under a business case would be a business license first, or the form may be in the form of sole establishments or a proprietorship, etc. And in certain cases where there are fiscally transparent entities in terms of a partnership or unincorporated partnership, the partners would be liable to tax on the profits and not the entity per se. As far as important deliberations are concerned, the requirement to obtain a business or commercial license would be a key driver to determine whether an individual is subject to corporate tax or not. So taking an example, simple case, if I'm doing a freelancing activity, which, as per the legal framework in the UAE requires a license to be taken from a respective authority, then I would be liable for corporate tax on an income which I earned from that freelancing activity. However, my personal investments, such as investment in equity shares, etc., where I would be earning dividend incomes, those would be kept out of the ambit of corporate tax. As far as legal persons are concerned, we have two categories, primarily the domestic entity and the foreign entities. Domestic entities are the ones which are incorporated in UAE and having a separate legal status. And in some cases, the limited or some other partnerships where the liabilities of the partners is not unlimited, those would be covered under the category of domestic entities. Now coming to the concept of foreign entity, and it's an interesting concept because foreign entities may have presence in UAE in some form. So even they would be covered as a legal persons in certain cases. For example, the branch office or representative offices, or those entities have a source of income in UAE under a deeming concept, for example, royalty income or interest income, etc. Or they have a business income by way of having a permanent establishment in UAE. And again, having said that, on the branch rep offices, sources of income and permanent establishment, even in the case if the overseas entities have a place of effective management in the UAE, even those entities would be within the ambit of corporate income tax, corporate tax law in UAE. As far as taxation of the permanent establishment is concerned, definitely the profits would be taxed of that permanent establishment. However, profit attribution rules in the case of a PE is not defined and would be largely in line with the international standards and would be dependent on the transfer pricing functional analysis, which would be dealt in the ensuing slides. The corporate income tax also exempts certain category of persons within the ambit of corporate tax. The first category being the federal and the emirate government and their departments doing a non-commercial activity. Second category would be the wholly owned government companies engaged in any sovereign or mandated activities. Third category would be the entities which are engaged in extraction and exploitation of natural resources. Fourth category being charities and public benefit organization. And the fifth category being the investment funds. It is interesting to note the exemptions may be automatic or maybe by way of an approval route. Likely, we understand at least the federal government and the wholly owned government entities would be under the automatic rule or automatic route. And charities, public benefit organizations, and investment funds, where there are certain conditions mentioned, they would be under the approval route. And approval route may be a time-consuming process and may be litigious because many terms and conditions would be attached to it. Now we come to the very interesting concept of tax residency, and it is important because your tax residency per se determines the scope of income, which would be taxable in the UAE. Starting with the resident individuals like you and me, national persons would be engaged in the business of commercial activities in UAE would be considered to be a tax resident in UAE. However, much clarity is awaited on the residency rules for individuals. Primarily because there's a concept of tax assistant residency certificate, and certificates are presently being given to the individuals as well. However, there are practicing rules which mandates 183 days of physical presence in UAE to be eligible for the tax residency certificate. But going forward, maybe we can see the rules to be amended as far as practice is concerned. Maybe have the next slide. Now coming to the corporates, the legal entities which are incorporated in the UAE as per the UAE laws are definitely the tax residents of UAE. However, the foreign entities which have a POEM in UAE, that is a place of effective management in UAE, would also be considered to be the tax resident of UAE. The POEM concept has been an important one. Though nothing would be there on the papers, it would be primarily driven by the decisions where the board of members sits, the minutes the board of members maintain, the strategic decisions, etc., the quorum requirement, and the key decision makers, as well as the operational aspects such as access or authorized signatory to bank accounts or the vendor contracts, etc. So this would be a gray area, and primarily the groups or the entities which have a regional headquarter in UAE should be aware of this concept, and at least we should have at least a risk assessment in place to check the POEM of their foreign entities in UAE. Maybe have the next slide. So continuing with the concept of total income, when you're a resident in UAE, a tax resident in UAE, your worldwide income would be subject to tax in UAE, unless we have a few exemptions like dividends and capital gains. For non-resident, the way it is worded in the draft, it says income attributable to a permanent establishment or income having sources in the UAE. Interestingly, permanent establishment finds a narrow concept as of now, the way it is worded in the consultation document. Going forward, we would see how the clear definition has been there for a permanent establishment. And the attribution rules also we will have to see, and it definitely would be aligned with the internationally known concepts relying on the transfer pricing function analysis. Now we come to the interesting concept of tax group, and we have a similar concept under the VAT laws as well. So under the corporate income tax, we will have a concept of tax grouping where in case you have multiple UAE entities, you can merge them into one taxable unit and file a single annual return for the corporate tax purposes. The concept comes with its own advantages. However, because of the few conditional requirements, the groups may not be able to form a tax group, or for certain business reasons, the groups may voluntarily not choose to form a tax group. The conditions for forming a tax group as of now is the minimum shareholding and the voting rights to be at 95%, which is a stringent conditions as we see as of now. The second condition would be none of the group member can be an exempt person or a free zone person benefiting from a 0% corporate tax rate. The third condition would be the consideration for a full consolidation for tax purposes. And for the fourth one is the mandated consolidated accounts and the provision of the same fiscal or accounting year. So these are some of the important conditions which will have to be fulfilled to form a tax group, without which you will not be eligible to have a group in place. Coming to the important deliberations as we were discussing, as the condition mentions about the consideration for full consolidation, we don't know, and the cherry picking may not be allowed. For example, you have 4 entities and you may wish to merge 3 entities and keep the fourth one separate. We will have to wait for the exact clarity to come in. So we say cherry picking may not be allowed. Second is the tax group, which is already there under the VAT regime or VAT law, may need a reevaluation. from a business standpoint. And a reasonable clarity would also be expected where we have a direct branch of the headquarters in UAE as well as the local UAE subsidiaries. So what happens in that case? And the last, but definitely not the least, the important criteria or the conditions which we see practically in UAE is on the sponsorship arrangements, where we have a local sponsor having 51% shareholding and the actual working partner having 49%. In certain cases, the tax grouping may also not be allowed. Going forward, we have again some special consideration for the groups, starting with the concept of transfer of business losses. This is something which is important, where the tax group cannot be formed, or the multinational or the business do not wish to form a tax group. So in this case, the loss of one entity can be surrendered in the favor of another profit-making entity. However, terms and conditions would be attached for such kind of transfer of losses. One of the conditions which finds mention in the public consultation draft is the minimum shareholding or common ownership of 75%. So in case you meet these conditions, together with some other conditions which would be prescribed, the loss of subsidiary one may be transferred to the profit-making entity, that is S2 in the diagram which is there on the screen. I'm going to another concept of group relief. This is important from a restructuring standpoint, wherein we will have some transfer of assets and liabilities because of some carve-outs, etc. Or maybe a complete restructuring, maybe the branch getting converted into subsidiary, vice versa, or individuals then be having a legal entity and business of the individual getting transferred to the legal entity, etc. So these kind of restructuring, it would be a tax neutral transactions. However, we do see that this requirement would be only in the UAE, that is UAE to UAE transactions may only be permitted for having a group relief. And we also see a minimum lock-in period of 3 years to be proposed to avoid groups to have an advantage of these provisions, etc., in a wrong way. Coming to the exemptions, as I mentioned, we have 3 kind of exemptions mentioned along with the free zone, which Mr. Manoj would be taking up. The first one being the dividends, second one the capital gains, and the third one being the foreign branch profit. So dividends and capital gains are fundamentally exempt under the UAE proposed corporate tax law. Again, some terms and conditions would be mentioned. Starting with the dividends, as far as the dividends are local dividends, they're coming from the local entities, those would be exempt. However, in case the dividends are flowing in through a foreign entity, the participatory exemption conditions has to be met. The first being minimum shareholding of 5%, and the second being foreign entity should be subject to tax at least at the rate of 9%. So in the picture which we see, holding company is there in UAE and S3, a subsidiary being outside UAE. In case S3 is declaring certain dividends, H Limited should have a minimum shareholding of 5% in S3, and S3 should be at least subject to tax at the rate of 9%. So coming to the important deliberations here, outbound holdings in no tax or low tax jurisdictions like British Virgin Islands, etc., would be impacted. So this kind of structures now may be inefficient. So we'll have to relook at these kind of structures. And in case there are any withholding tax suffered at the foreign entity level, such withholdings, we don't know whether any refund could be claimed in UAE or not, because there is an exemption in UAE. So that was on the dividend part. Maybe our next slide. Coming to the capital gains, again, similar conditions have been kept to exempt the capital gains for downstream investments, primarily to encourage the holding company region or investments in UAE. As far as the capital gain is arising from the alienation of shares of a UAE entity or a foreign entity, that's a condition of, again, a participatory exemption, shareholding of 5%, and in case of foreign entities, that entity should be subject to tax at least at the 9% rate. However, interestingly, they have few conditions mentioned for a free zone entity. And this is something where UAE entity alienates, sells the share in a free zone entity, which in turns hold investments outside UAE. So there's an additional condition prescribed for a free zone company. It should be a holding company, and substantially all the income of the company should be from the entity meeting the participatory exemption criteria. As of now, the draft does not mention or does not define clearly what do we mean by holding company, what do we mean by substantially all the income. So we'll see exactly how it is defined, or maybe it might be a plain vanilla definition of a holding company, simply holding shares of overseas entity. So again, coming to the important deliberation, as I mentioned in the previous slide, the outbound structures may be impacted, specifically when they are in British Virgin Islands or Cayman Islands or any other islands which do not have a corporate tax in place. So those structures might be inefficient and has to be relooked into. Maybe have next slide. Yeah. Coming to the branch profit, and this is the case where a UAE entity has multiple or single branch outside UAE, for example, KSA and UK in our picture. So exemptions are there. So there are two options given. Either you pay tax on the profits of the foreign branches in UAE and take foreign tax credit of the taxes which have been paid outside UAE, for example, in KSA or UK. Or a second option would be to claim a branch exemption. However, this exemption comes with certain terms. The exemptions has to be applied for all the foreign branches. So you cannot have a cherry picking approach here. Second, the option to elect exemption is irrevocable. Once you're in, you have to be in forever. And third condition, and very important condition, is foreign branch should be subject to sufficient level of taxation in the foreign jurisdiction. So these are the three conditions which has to be met simultaneously. Coming to the deliberation part, this exemption or either of the selection of either of the methods has to be done diligently. Of course, the exemption method would make sense, because of the less documentation requirements. Otherwise, when you go and claim a tax credit for foreign taxes, you'll have to have additional documentation, for example, TRC, or maybe the evidences of the tax which has been actually paid in those jurisdictions. Now coming to how would be the taxable income be computed. As I mentioned in the previous slides, the way it is worded in the public consultation draft, the starting point would be the accounting net profit. So we have tried to simulate at least a draft statement of net taxable income, which would be primarily applicable for mainland entities. So we start with the net profits, and net profits are as per the financial statements, and financial statements at least will have to be aligned with the internationally known accounting principles. Definitely will have certain exemptions for SME groups, the small and medium enterprise groups. However, the conditions are not been mentioned as of now under the consultation paper. So we start with the net profits. We make certain adjustments. First being the expenses which are expressly disallowed. For example, unrealized gain on any capital item, the interest expenses beyond 30% of EBITDA, that is earnings before interest, tax, depreciation, and amortization. Entertainment expenses beyond 50%. So it is likely that the balance 50% would be having a personal element to it. Then we say donations to any unapproved organizations, the fines and penalties or recoverable VAT, or any personal or capital expenditure which are debited in the profit and loss account, or maybe the prior period items or the expenses which are not linked to taxable revenues. So these are only the indicative list. Some of them are expressly mentioned in the consultation draft. Some of them would be deemed disallowance, citing the international experience. And we may also have certain specific disallowances mentioned in the actual law. And simultaneously, we'll have some exemptions like dividends, capital gains, foreign branch profit, which will have to be removed from the accounting net profits. And of course, certain special allowances or incomes, or maybe the transfer pricing adjustments, upward adjustments primarily. that may also be added to the net profit notionally, and then we arrive at the taxable profits, which the rate of tax is then applied to. Maybe at the next slide. Yeah. So coming to the computation of tax liability, once we calculate the net taxable income, we have a 0 rating up till the taxable profit of 3,75,000 dirhams. Above 3,75,000 dirhams, we have a rate of 9%. However, this rate may likely be 15% for a large multinational group entities crossing the revenue threshold of 750 million euros. But reasonable clarity is expected for that 15%, likely 15% corporate tax rate. So then we have a next total corporate tax liability, which we reduce by a foreign tax credit if at all we have suffered any withholding taxes, etc., in foreign jurisdiction. And then we arrive at the net corporate tax liability. So from a deliberation standpoint, at least what happens in the case of foreign entities, UAE sourced income, whether those will be taxable at gross level or net level, we'll have to wait for the exact clarity to be in place. So I'll just run through some of the key administrative aspects, first being the registration. Once the corporate tax kicks in, the in-scope taxpayers will have to get it registered before the federal tax authorities and obtain a tax registration number. Similar exercise we are expecting the way we had it in VAT regime. Second would be the compliances, the computation of tax liabilities, payment of tax and filing of the tax returns. And a reasonable amount of time has been proposed for filing the tax return, that is 9 months from the end of the financial year. Third step would be the assessment. The review of the return of income filed by the taxpayer would be done by the federal tax authorities, and will have the assessment order in place within a prescribed time frame. And in case we have a modified assessment, some additional liabilities are there proposed by the FTA, then we have the route of litigation, so we can appeal against the order of the assessment. The exact mechanism for the appeal procedures, assessment procedures, compliances, etc., would be prescribed in due course. Interestingly, we have the concept of seeking a binding clarification from a federal tax authorities. If I draw an analogy from a VAT law, it is something like a private technical clarification. And if I draw an analogy with an international experience, it is something like advanced ruling from the tax authorities. And we will also have some additional documentation requirements in place. So that was it from my side. I would just hand it over to Mr. Manoj Pandey to take the presentation ahead. Thank you very much. Have a good day.
Thank you, Vineet. And good afternoon, friends. My name is Manoj Pandey. So I'm a chartered accountant by profession. I'll take you through some of the important aspects of the corporate tax announcement. So going further, one and a very important part is the free zone. So entities in the free zone are actually 0%, or we can say they are tax exempt. But the exemption comes with certain conditions. And those conditions are that, the entities should have a substance, they should have an audited financial statement. Number two, they should be complying with all the regulatory requirement as prescribed by the free zone authority. And then importantly, they should not be making any transactions with the mainland. When we say transaction, they should not be having customers in the mainland. But of course, there are certain exemptions. Those exemptions we'll talk in the subsequent slide. Which are the types of entity which enjoy the exemption? There are two. One is branches, and the other is any company which is registered in the free zone. Now, important here is that the economic substance, when we say economic substance is something which means that, your employees, your assets, your management is all situated in the free zone. So the structures, where the management is situated in a mainland or a free zone entity is situated or established just as a warehouse for the purpose of, custom duty exemption or for VAT benefit. all those structures will need to be reevaluated. Going to the next slide. So here, if you see, a free zone is on the circle, and on the left hand side is a transaction which are happening with the outside UAE. So the transactions with customers outside UAE is all subject to 0%. And on the right hand side, you see on the mainland transaction. So some of the transactions are permitted but subject to certain conditions. So for example, if there is a transaction with a branch, so free zone entity transacting with its branch, that is permissible, but the branch in this case will be subject to the regular corporate tax. The free zone entity can derive passive income. So passive incomes are in the nature of interest, royalty or dividend or capital gain. Those incomes are permitted to be, earned by a free zone entity. Now, transaction with group companies are permissible, but in that case, whatever payments are being made by a group company, it will be disallowed in their hands. Free zone person can also sell goods to a person, who is an importer on record. And a free zone person should be situated in a designated zone. In those cases, such a transaction would be permissible. Now the basic question which comes is that, all the entities, in a free zone, which do not have substance or who are transacting, even a small portion of their turnover is coming from a mainland, it would make sense for them to, look at a carve-out structures, or maybe to transfer the customers to a mainland entity. If the mainland entity is already there, then it can be transferred to those entities, or there can be another option to set up a branch and then transfer those, contracts to the branches or the other entities. So in this case, you can enjoy a tax exemption, but in all cases, this structure is not, recommended, because there could be a possibility that there is not much profits at the free zone level. So in case if the profits are only up to the extent of 375,000, then in that case, it will not make sense. So all these, permutation combination would require an analysis. We will also need to see whether a free zone person is a part of a group company structure or not. And if you take a group registration, then in that case, what would be the impact? Whether at a group level, the net result is a taxable profit above 375,000 or less. Then after seeing all those cases, or analyzing the situations, one can suggest whether to, transfer the customers or transfer substance or not. Going to the next, there will be transitional rules. So transitional rules are basically prior to corporate tax regime. If you are moving on to the corporate tax regime, that what are the rules that you need to follow? So the first and foremost is that, the opening balances, it doesn't need to be, audited. It's not required, doesn't require any kind of an audit. You can carry the opening balance as it is. There will be, of course, some impact in case your opening balances are qualified or the balance sheet is qualified, having some red flags. Then in that case, the tax authorities, they can look at the transaction in more details. And the cut-off procedures will come into place. So for example, you have losses prior to the corporate tax regime. Those losses will not be eligible to be carried forward for future years. Going to the next. Yeah, so this is a concept, I think Vinit just talked about it from a cross-border standpoint. So any foreign entity which is deriving income from UAE, per se, those incomes could be taxed in UAE, provided where, a foreign entity has a permanent establishment in UAE. So when we say permanent establishment, they have defined two types of permanent establishment. One is a fixed place and the other is a agency P. So all these structures, when your foreign entities, they are doing business in UAE by having an agency contract arrangements or a sole agent, then in that case, those structures would need to be relooked into, because in those cases, a foreign entity can be regarded as having a permanent establishment and it could be subject to tax at the rate of 9%. Same way, if a foreign entity has any kind of a branches or they are using some customer place on a fixed basis, regular basis for a period which is exceeding 6 months, then in that case, permanent establishment exposure and tax risk could arise. So largely all these concept of permanent establishment, would be borrowed from the OECD principles. So that is something which is internationally accepted, well-known principles, and there will not be something which is new to be introduced in this part of the world. Going to the next. Transfer pricing regime is another important area which will be introduced. So the threshold of applicability as such is not defined as yet, but the rules of related party, they have prescribed that anything over and above 50% shareholding will be regarded as a related party. So whether you are transacting cross-border with a related party, with the group companies, or whether the transactions are being made within the UAE intra-group transactions, or with the shareholders, or with the directors, or with connected person, all those transactions should be undertaken at an arm's length principle, or should be in a simple way, it should be at the market price. Going to the next. So when we say related party transactions, so in this particular example, you can see outside UAE Limited, if it transacts either with S2, who is a UAE mainland free zone, or if it transacts with S4, which is the permanent establishment of S1, of H1, then in that case, the transfer pricing rules will be applicable. So transfer pricing means that the documentation, benchmarking, and all the transaction has to happen at an arm's length price in the same way, and like you would have done a transaction in an uncontrolled circumstances with unrelated party. On the insights into the UAE South Africa tax treaty, the good news is that there is a tax treaty. So tax treaty means that the South Africa resident companies, they can enjoy the beneficial provisions which are there under the UAE and South Africa tax treaty. So that is one important point. So any beneficial provisions can be can be relied upon and can be used to avoid a tax in UAE. Now, if you go to the tax treaty, what we have found is that the definition of permanent establishment, which is the main tool as to how the foreign entities are being subjected to tax, definition as prescribed under the UAE public consultation document is narrower than the tax treaty. As such, a tax treaty doesn't give any further advantage or doesn't give any further protection. So that way, the domestic tax law would be much more beneficial. And from a permanent establishment standpoint, this is not going to help. And on the other side, on the withholding taxes, double taxation, we'll go into the next slide and see how it and what are the beneficial rates. Going to the next. As we see that there is no withholding tax in UAE. So whether all payments made for the interest, royalty fee for technical services, or dividend, they are not subject to any withholding taxes. So because there is no withholding tax here. So from a tax treaty perspective, it says that income originating from UAE will be taxed in accordance with the UAE laws. So that is something, it will be taxed in accordance with UAE law. So UAE law, if there is a business profit, it will be taxed only in case if a foreign entity has a permanent establishment. In all other cases, we have to see the deeming rules, which will be announced shortly. Withholding tax, as we discussed, there will be no withholding tax. Going to the next. Now, transfer of sale of shares. So if there is an entity here in UAE and if you are transferring shares, then the tax treaty says that capital gains will be taxed in UAE. And as such, UAE has only the business profits, being taxed here. So capital gain is something which is not proposed as of now. We'll have to wait and watch and see as to how the law, defines all these aspects, and then accordingly, one has to take a view. Right. Impact on businesses. So see, the corporate tax is basically a tax on the net profit. And net profit, when we derive, it is derived after deducting all expenses from the revenue. So from that standpoint, it has a 360-degree impact on the business. So let's see in the next slide what kind of an impacts you may have. Going to the next. Right. So if you see in this case, wherever there is a group structure, all those possibilities of inefficiency could be there because assets may not be in a proper, form and shape. There could be issues on the ownership of the asset. The ownership may be lying with the shareholder, but the assets are used by another company. There may not be proper documentation which proves the ownership of the assets. There could be some entities in a free zone, but free zone entities are deriving income from mainland entity. It could jeopardize their tax exemption. Same in mainland entities, they are deriving export revenues. It would make sense for mainland entities to transfer those export revenue to the free zone entity. And there could be there will be a lot of sense to convert the branches into a limited liability company because branches is considered, or project office considered extension of a head office. So there the permanent establishment risk is automatic. There could be possibility of rerouting of transactions, turnkey projects. All those aspects will have to be looked into because there could be a lot of tax exposure, especially because of the permanent establishment concept or because of the POEM concept. The IT and MIS system will have to be relooked into because certain expenses can be captured in a way as to what is required under the corporate tax. For example, the entertainment expenses, certain penalties, or certain expenses which are provisions made on ad hoc basis, those may not be allowed as a eligible expense. Same way, the systems can be made in such a way that if particular invoice is not in the name of the company, it is already notified to the finance team that this invoice has some problems. It could raise issues or concerns from the allowability perspective. Same way, if some particular expense or invoice pertains to the prior period, doesn't pertain to that period, then also the IT system can pop up and notify the finance team or tax team that this invoice has got issues. On the profitability aspect, because this is a hit of 9%, then all those margin restructuring options will need to be reevaluated. Cash flow management will have to be relooked into, transfer pricing, benchmarking, documentation, accounting, audit. All these aspects will have to be relooked into, and one can see each on a case-to-case basis, and we can come up with a efficient and better structure which can help the company to optimize the taxes. Going to the next. So our value proposition, if you see, we are already suggesting to our clients on the diagnostic review, on the impact assessment. So when we say impact assessment, we are helping clients to understand what is the corporate tax impact they'll have to deal with in the first year in terms of compliances, in terms of liability, in terms of risk exposure, what are the gray areas. There could be a possibility that it is not very well defined under the law. In that case, the jurisprudence as is applicable globally will have to be used. That is something where we can help companies with our prior experience. We have a lot of good connect in the FTA also. We have people who have worked in past in FTA. So that way we are, have a lot of ease in terms of obtaining any kind of a clarification a private clarification for the companies, and we can take positions which is more, balanced positions that, doesn't pose much tax risk for the companies. Now, phase two, we can help the companies in implementing the structure that we have suggested in phase one, and phase three will be to complying, obtaining the registration, and making good all those compliances on a yearly basis. So this is all about that we have on the corporate tax side, and we'll be more than happy to take the question.
Fantastic. Vineet, Manoj, thanks for taking us through that. I think it was a very comprehensive presentation with lots of food for thought for many people. I know we've got a few minutes left. We've got some questions, if you guys don't mind, just waiting and answering some of these questions. Vineet, maybe I can give the first one through to you. The first question is from Huzlat Mabasa, and his question is, what is the threshold for 15% CIT? You mentioned that it will apply to MNEs.
Yeah. So first of all, it would be likely 15%. The draft or the FAQs mentions a different rate of tax, but drawing a clue from a Pillar 2 global minimum tax project of OECD, we say likely 15%. And yeah, so if the entity is part of such groups, the different rate of tax would be applied. However, we have only few aspects as of now because a reasonable amount of clarity is awaited. How that global minimum tax project would be incorporated under the UAE corporate tax law.
Okay, great. And I guess, as you said, as more clarity is received, and hopefully you guys will send that information out to everyone so that those questions are answered. I've got another question also from Huzlat Mabasa. Manoj, I'm going to ask you if you perhaps can take this one. So his question is, will a non-resident company with a branch in Dubai trading services, as an example, with customers outside of Dubai, qualify for the 0% CIT or for free zone exemption?
So if I understand, the entity's branch is registered in a free zone, right?
Mm-hmm.
So in that case, of course, yes, it will be enjoying that 0% corporate tax exemption, provided all the conditions, other conditions are met. So for example, the annual audit is there, audit report is there, and all the revenue is coming from the export. There is no mainland revenue. And thirdly, that the branch fulfills all the regulatory compliance obligation as are prescribed by the free zone authority. Then in that case, it will be.
Okay, great. Thanks, Manoj. I've got another question, and you guys can decide who wants to take this one. It's from, apologies if I've got this name incorrect. It's either Rin or Ryan Welder. And the question is, if you have a company that is liable to pay royalties to headquarters, which will be outside of the UAE, will any royalty that is paid to the HQ headquarters outside of the UAE also be fully tax deductible? Who wants to take that one?
Yeah, I'll take that. So, the royalty is something that, requires two tests. Number one, that who is, whether the entity which is paying the royalty is getting benefits out of such payments or not. And since this is a transaction with a related party, it is being paid to the head office. It will also be subject to the detailed documentation and benchmarking rules. So we need to ensure that the royalty is not excessive. It is according to the market best practices. And if those conditions are met, then there will not be any issue in allowability of those royalty expense.
Okay, thanks, Manoj. Manoj, while you've got the mic, just going back to the earlier question that Huzlat Mabasa asked, and I think we assumed that he was referring to a branch that's in the free zone, but he's just clarified that the branch is not in the free zone. So maybe just to repeat his question, will a non-resident company with a branch in Dubai trading services with customers outside of Dubai qualify for the 0% CIT or for free zone exemption? And this is for branches that are not in the free zone.
Well, in that case, it had to suffer a normal 9% corporate taxes. It will not be subject to exemption.
Okay, fantastic. Thanks. Vineet, I've got one more question that hopefully you can take, also from Reinvalda. The question was, are you aware of any tax depreciation calculation methodology?
Okay. As of now, again, the draft doesn't specifically mention depreciation, but definitely a depreciation would be an allowable expenses. What may differ is a rate of tax in case a separate, register is prescribed for the corporate tax purposes. In case a separate rate, separate register is not prescribed, then we believe it would go as per the accounting principles and the accounting standards uh, through which the financial statements are prepared. Having said that, we'll have to wait for the exact wordings of the law for the depreciation allowance.
Okay, thanks. If you guys don't mind, I think maybe two more questions that I think might be pertinent. Vineet, if I can maybe give you the first one. How would tax group work for those companies already under VAT tax group, under the VAT tax group?
First, let us understand the purposes under the corporate taxes and the VAT law. The tax group concept under the VAT law has a different objective because VAT is a consumption tax base, because ultimately someone in the line pays the VAT if at all the transaction is subject to VAT. So the revenues ultimately flow to the government, though not directly but indirectly. So tax group under the VAT is defined, or it's constructed in such a way that at least the intra-group transactions wherein debit credit, or input tax, output tax, the number of iterations are reduced. But under the corporate tax, the objective is different. Possibly having ease of compliances, a single taxable person, then one entity is profit making, another is loss making, so we combine the accounts and we have the benefit of the net results, etc. As of now, we what we say is it may go parallelly. The tax group may have a parallel case with a tax group, so a different documentation, etc., will have to be maintained unless something is clarified in detail once the law is in place.
Okay, thanks, Vineet. One final question, if you may, Manoj, if I can pass this on to you. So as you guys have said, exports done by a mainland company would obviously not enjoy any incentives vis-a-vis a free zone company. So in this case, will it be beneficial to carve out the export business into a free zone company?
Yeah, it will make sense. But the export revenue, carving out export revenue to a free zone entity will also mean that you also transfer all the ecosystem of that revenue. So all the employees who are engaged in generating such revenue, they also gets transferred to the free zone. All the assets which is used to for the purposes of generating that revenue, that also gets transferred. So everything gets transferred. So in a way, we have to also move the substance or all the related uh, assets, employees, etc. to the free zone entry, then it will make sense.
Okay, thanks. That's a fair point. Thanks, Manoj. So I think we've reached the end. So once again, thanks to everyone for making the time to join this webinar today. Manoj and Vineet and all your other colleagues from MBG who helped to make this happen. Thanks for making the time to present to our attendees today. Much appreciated. I'm pretty sure the subject's going to run between now and June next year. As we get more clarity and people start to really get to grapple with what it means, and during that process, I think we'll probably unearth a lot more questions as people get to understand the topic better. So I'm pretty sure that over time we might ask you to come back, to come and present again once people know what they need to ask and understand the topic a bit better and the requirements a bit more. Once again, MBG, thanks for your time today, and to all the SABCO members and all the other attendees, thanks for making the time to go through this webinar today. Enjoy the rest of your day. Thanks. Bye.